For 4 weeks, Donald Trump insisted the Iran conflict would last 6. The bond market is now saying it could last long enough to force the Federal Reserve to raise interest rates, not cut them. Futures markets closed Friday with greater than 50% probability priced in for a rate hike by year-end. That is the first time that threshold has been crossed since Trump won the presidency. The Dow entered correction territory. The Nasdaq fell more than 10% from its peak. And the 10-year Treasury yield had 4.44%, its highest level since July 2025, on its way to what barons called the worst monthly bond performance in years. The week the market stopped listening to Trump. 5 straight weeks of losses. That is the streak the S&P 500 extended Friday, closing at 6,368, a 7-month low. The Nasdaq dropped another 2.15%. The Dow shed 793 points in a single session. The trigger is well understood. Brent crude has surged above $110 per barrel as Strait of Hormuz incidents disrupt tanker flows. The University of Michigan Consumer Sentiment Index fell to 53.3 for March. One-year inflation expectations jumped to 3.8%. None of this was supposed to happen on this timeline. Trump spent last week repeatedly postponing his threat to strike Iranian energy infrastructure, believing delay would calm the market. It did not. Each postponement has been read not as de-escalation, but as strategic ambiguity, and markets have stopped pricing in resolution. The Middle East war now appears to be broadening and deepening, Capital Alpha Partners wrote Thursday. Their base case now assigns only 25% confidence to a negotiated exit before 2026. One analyst placed the conflict potentially extending into 2027. The stocks absorbing the most damage are the ones most exposed to the policy contradiction at the center of this market. Meta fell more than 12% for the week. A landmark social media liability verdict piled onto an already nervous tape. Amazon dropped 3% Friday alone. Microsoft is now down 24% year-to-date, tracking towards its worst quarterly decline since 2008, even as it posts 17% revenue growth. Why a cut mandate is now producing hike expectations. Here is the contradiction. Kevin Warsh was nominated to chair the Federal Reserve with an explicit mandate: cut interest rates. Trump made this agenda public. Warsh himself has spoken about regime change at the central bank. The market understood the plan. And yet CNBC's analysis of Warsh's situation notes flatly that $100 a barrel oil and rising inflation forecasts are the most obvious obstacles to that agenda before his confirmation hearing has even been scheduled. The Philadelphia Fed president said Friday there are no signs the labor market is contributing to inflation. That statement, meant to be reassuring, landed in a market that has already moved past labor. The variable now is energy, and energy is outside the Fed's reach.
The mechanism is not complicated. Oil at $110 feeds directly into transportation costs, input prices, and headline CPI. Mortgage rates have climbed as markets reprice the inflation outlook, and mortgage applications have tumbled since the war began. The housing affordability agenda, one of Trump's stated domestic priorities, is now being quietly dismantled by Hormuz. Traders who spent months pricing in 2 or 3 Fed cuts this year are now pricing in a hike instead. This is not panic, it is arithmetic. If Brent holds above $100 through Q2, the Fed cannot cut without risking an inflation overshoot it has spent 3 years trying to avoid. The bond market figured this out before equity markets did. That gap, bonds repricing hawkishly while equities still held, has now closed violently in both directions. The Dow correction is a symptom. The real repricing is in rate expectations. The number that breaks this logic. The rate hike scenario holds only if oil stays elevated. That is the single hinge. Trump pushed back his timeline for striking Iranian energy infrastructure again on Friday, and oil actually fell on the news, briefly before recovering. That brief dip reveals the market's conditional logic. The moment a credible path to Hormuz normalization appears, energy prices fall, inflation expectations reset, and the hike probability collapses. The Warsh cut agenda revives, equities stabilize. The historical comparison is 1973, when the Arab oil embargo sent markets into a bear run that lasted 23 months. The differences today are meaningful. The U.S. is a net energy exporter, shale production can respond within months, and the conflict is geographically contained, for now. But the 1973 playbook also showed that the market does not wait for resolution. It reprices in stages, each escalation extracting a new leg down. 2 scenarios diverge from here. If Brent crude falls below $95 on any sustained de-escalation signal, a ceasefire rumor, a Hormuz clearance, a Trump-Iran back-channel report, the hike probability retreats, bonds rally, and the equity correction finds a floor. If oil holds above $105 through April, the Fed's next meeting becomes genuinely contested for the first time since 2023. The verification benchmark. Watch the May federal funds futures contract. If it continues to price a hike probability above 40% heading into next week, the correction in both bonds and equities has further to run. If it retreats below 30%, the paradox resolves, and the market begins pricing Warsh's original mandate again. The question is not whether Trump can negotiate a ceasefire. It is whether he can do it before the bond market forces the Fed's hand.